We're going to do two things. We're going to have a conversation now for about 20 minutes or so, and you can participate by using the Hoover app, asking questions, and then we're going to launch into Pitch Club, 6 companies, 6 minutes each, pitching their business, and so on. I'd like to invite up onto stage now Fredrik Bergman and Hanna. Come on, guys, grab a seat. Joe can sit there. Fredrik, you can sit in the middle. I'll sit over on this side. Okay. I know Lola didn't want me to sit this way.
No,
we're sitting this way.
Lola wanted you in the middle. Anyway.
Okay. Now, I've asked Fredrik and Joe to join me to talk about capital raising and the challenges for the PropTech world for a reason. Fredrik runs PropTech Farm and Joe's a partner at Fusion 4 Ventures. So, Fredrik, why don't you introduce yourself briefly?
Yep.
Just who PropTech Farm is and a bit about yourself, and then Joe the same, and then we're going to launch into some interesting questions around tips and techniques for companies to actually raise money, because it's a super challenging market.
So I'm the CEO of PropTech Farm that was founded in 2021. Many of you might have seen me before in Diacrete. So I was the founder of Diacrete, which I sold 2 years ago. Today we invest in startups, early stage, post revenue, and proven track records. And now we're actually doing a joint venture with Fusion 4 Venture here in APAC region, and we're going to launch this fund now. And we're going to talk more about that, I assume. So.
Okay, and Joe, your background?
Yeah, Hanna, one of the founders and partners in Fusion 4 Ventures. In a nutshell, we help PropTechs globally scale to exit, and we do that in multiple ways. One is through the fund that we're setting up with Fredrik. I'm sure we'll talk about that later. And another is by helping them grow through advisory and other services.
Okay, and your background is?
I was one of the founders of PropTech Group, which we listed on the ASX in 2020 and sold in 2022 to MRI, and prior to that, Mature Group.
Okay, so extensive experience from both of them in both the operational side, building businesses literally from day one, what's the idea, right through to raising money and exiting. Mm-hmm. Joe's got some listed company experience. Fredrik's dealt with listed companies and selling his company to them, and some experiences in that as well. So lots of deep experience. Now, these two gentlemen helped me out on the Startup Day. So if anyone who is here who didn't come to Startup Day on Tuesday this week, we had a full day about what it takes to build, run, operate, scale, fund, and exit a startup. And I thought that we had about 70 people. It was a super interesting day. Lots of conversations and really in-depth analysis and war stories on what works and what doesn't work. But let's start with the most obvious question to you, Fredrik. Is raising money as a PropTech at the moment easy or hard?
It's still quite hard, because one of the reasons for that is that since 2021, the whole ecosystem have been hurt. You have everything from friends and family, angels, early stage VCs, PE firms, family offices, etc., and the whole ecosystem have been really hurt. So if you look at some facts, that actually 2023 was quite low in the investments on the market, was only $12 billion into the PropTech sector. Same number was 32 billion in 2021.
So wait a second, that's literally
a third.
70% down,
yeah. So
60% down over literally a 2-year period.
Because we are all feeding each other in this capital market, so the angels coming in early maybe want to leave at the A round, early stage VCs coming in early stage and want to maybe leave A in the B round. So, but if this doesn't work, the whole ecosystem stands still. So I actually met a Hong Kong family office in Abu Dhabi a couple of weeks ago, and he said they never had so much money to deploy. Yeah. They have the banks full of money, but no one is moving. So it's very hard to get the money going.
Okay. And if we look at the valuations, Joe, how have they moved over the last 3 or 4 years?
Oh, well, they've certainly gone south. I think Fredrik's point is a poignant one. Particularly in the region, there is a lot of money that's around. It's just not being deployed. so that the fund managers are almost being rewarded for saving money and making the right deal. Whereas if you think 2021, where the market was buoyant, I wouldn't say it was necessarily easy to raise money there, but it's certainly easier. A, it was easy to raise money, and B, on attractive valuations. I think we've all seen, at least in this group, down rounds. The companies that desperately need to raise money did it at a higher multiple previously, now having to do down rounds. So certainly valuations are being compressed. Gone are the days of 10, 20 times revenue, aspirational, and there's been a shift towards profitability more and more, both all the way from the capital markets through to the private markets. Companies, fund managers want to know that there's a pathway to profitability, that there's sustainability in the company, and that they're not going to continue to fund.
When you talk about down rounds, how much down are we talking about? 10%, 20%?
50, 60, 70, I mean, significantly down.
And if you look at the public markets have certainly, for many of the stocks, not all of them, some of the, like the REAs of the world, and have certainly maintained, if not grown, their value. But a lot of them have had sort of significant re-ratings of their stocks.
Yeah, absolutely. And the capital markets are typically a little bit behind what happens in the private sector. But we certainly saw it. I mean, a lot of secondary tech stocks across multiple jurisdictions and multiple exchanges are significantly down. Multiples are significantly down. Sure, the cream always rises to the top, the REAs continue to grow, but certainly if you're sub 100 million market cap, and we had this exact experience with PropTech Group where we reached 100 million in market cap, grew revenue, grew profitability, and our market cap dropped. At one point it was a 40, 50 million, so a 50% reduction, even though the business was going well.
Okay, so it's just this general re-rating. Yeah. So you've painted a bit of a doom and gloom picture, guys. Come on, right? You know, it's hard to find money. Yeah. The people with money are really only wanting to invest in those businesses that are making money, which is a little bit of a problem because the people who really need the money are the ones who are not making money, and they've got to sort of invest for scale. So if you're one of these companies that are trying to gain funding, what are some of the tips and techniques? You know, I want to think about this. Who should they be approaching, and how should they be positioning themselves to that company? And what are some of the do's and don'ts in that positioning conversation? So who should they be approaching?
Yeah, first of all, I think you should approach your friends and families, angel networks and so on in the beginning, and you have to work a little bit more with that kind of money, a little bit longer now than before, and then grow up the chain. So, and then, of course, in this region, if you're in the PropTech sector, you should contact us, because we are raising funds now and we're investing in this sector.
So, and then if you also think about who, clearly don't think IPO, don't think about the big picture. I think they're sort of very aspirational dreams, and the emphasis on the word dreams around that. And when you are thinking about, you know, you have the conversation, how do you get in touch with the person, and how do you do that? How do you initially get someone who's getting, and I get every day at least 3 or 4 pitches sent to me, how do you get my attention or someone else's, an investor's attention?
Yeah, look, it's a good question. We covered this off to a certain degree the other day in the startup. Whilst we're painting a doom and gloom picture, there's still, as we said, a lot of capital that's ready to be deployed, and for the right projects, they'll still be deployed. So I think it's less around it being impossible to raise money and more around the narrative of the metrics that you need to include to entice investors. So gone are the days of the aspirational, you know, big dreams and unachievable, you know, pie in the sky visions that aren't tangible, and we're now moving towards a very regimented traction, KPI-based. Show me a path towards that. This isn't a hockey stick, is actually an achievable goal for the next 6, 12, 18, 24 months. Then in terms of how you connect with the right people and the right register, I guess, in your cap table, is finding the right strategic partners beyond the friends and family round for the next round is critically important. So more and more we're seeing fund managers look at the existing shareholder base and saying, are there other experts? Are there people that have done it before? Is there people that can guide you through? You know, are we following someone? I don't know, Fredrik, you're probably seeing this too for the larger funds, less leads. Like finding a lead is important. Whether that lead is someone that has strategic smart money.
So you're talking about a lead investor.
Leading the investment, correct.
And what does that lead investor do?
Well, three things. One is they typically set the price and the valuation. The two is they commit their money first, and that then entices others to say, okay, well, if they're in, if Simon's in, then clearly he knows what he's doing, we're going to come in as well. And in many instances, the lead investor doesn't typically write the biggest ticket size. In many instances, they're just a small chunk of the total raise. They're just the first to do it, the first to commit.
And they're putting their brand behind it.
And they're putting their brand behind it.
And they're also probably doing the due diligence.
Correct.
Right.
Yeah.
So if they say, this is a good business, I've done the due diligence, I'm liking what I'm seeing, I think the management's good, I'll put in 10% of the capital raise, that gives confidence to the other investors. So it's about finding a good lead.
Yep.
Okay, and how do you...
And then just another tip, if we got a tip in the startups out here, is to definitely now is to look for really smart money, like people, investors who can help you, because it's not going to be easier the coming years. We all know that. It's going to be bumpy. We don't really know where we are with interest, etc. So I think you need to have even more active investors now than ever before, because just 2021, everybody got money actually in the autumn of 2021. It took me literally 4 days to fill the fund. 4 days, boom, the money was in the account. It's taking a longer time now. And it's the same for the startups. And you really need to have the people and the investors that really know the market, can help you through problems and challenges that we're having now.
Okay. Now, so the way I think about it is, if I'm raising money it doesn't matter where I am in the process. I've got to raise a reasonable amount of money that's going to not last me 6 months with the hope of another raise, but it's going to last me maybe 18 months. Yep. Okay. 2 is I need to make sure my valuation is reasonable. Don't give me a valuation that's 10, 15, 20 times revenue, because the investor has way too many choices coming in. Remember, you're talking to someone who has choice about where they're going to invest. So, and they want to get upside in that investment. 3, give me confidence that you're going to treat my money well. Okay, you're going to be smart about where you deploy it. 4, give me realistic forecasts and demonstrate to me that at the unit economic level, it's profitable or will be profitable, and that within a reasonable amount of time, you should go from investment to break even. You can operate at self-funding growth, then with a trajectory out of it. And then the last thing that's always important is, and give me an idea of who would realistically buy this. Yeah. And don't just write the names REA or or whatever on a list, because we all know that's bullshit. It's got to be who realistically would buy this and why this would strategically make sense to them to acquire. Would you think about keeping it very simple, that list of...
Definitely. And I think the other point to raise in that is what seems to be different now than in 2021 and beyond, or previously, is it takes a lot longer. So investors and fund managers are spending a lot more time, a lot more due diligence over an extended period of time. So we said the other day, always be raising money. I think that's never truer than this moment in time. And typically for some of the companies that we're helping, investors are following for 3, 4, 5 months. All right, you said you're going to do this forecast in the next quarter. We're going to track to see if you actually delivered that before we commit the money. So I think the other point is start planning ahead. So I think the point you raised about getting the right level of funding is critically important, given that it's taking 3, 6, sometimes 9 months to raise money.
Okay, so to help solve this problem of it's harder to get funds, Fusion for Ventures and PropTech Farm have joint ventured to create PropTech APAC 1, which is a fund. Fredrik, tell me a bit about the fund.
So initially we are raising $15 million US dollar, and
15.
15, yeah.
Yes, because we clear.
And we are targeting seed companies in the region. As I said, post-revenue. Ticket sizes roughly between 500 to 1 million US dollar. And we are looking to invest and take a stake, rough average around 10 to 15% in the company, because we really want to help the companies. We want to give the experience from these guys, and Gonzalo and myself and Linus, etc., and Mike, of course, who's coming up on the stage soon, and help the companies grow, open doors, networks, this network here, etc. So that's what we want to do now. And then we're going to grow this to more funds as we go. For investors, we are looking for money, so ticket sizes is lowest is 100K.
Okay. And Joe, when you think about what the fund will be looking at, what are the sort of companies that are going to be most attractive for the fund to invest in?
Yeah, so I guess given our collective experience, clearly PropTech, early stage PropTech businesses that we see global application for, that don't need to be global but need to be able to focus on a market, but we could take global. Then I think some of the other benefits of us is, if you look at some of the things we've done historically, collectively, is connect companies from other parts of the world and grow faster. So, I think three main objectives. One is having a fund that has exposure and experience of creating value. Having a fund that can think through the next follow-on rounds, which is another important point, I think, for startups, is you've got to think about the corporate financial structure, the capital structure beyond what does it look like in Series A, what will Series B look like. So having the ability to follow on, I think, is critically important. And then the third is having a business that you absolutely believe in that can deliver returns for shareholders, and I think that's part of what we look for.
Okay, so the way, because I'm involved in it, so I'm biased here, but the way I think about it is, if you want to invest into the PropTech world and you're not quite sure where to invest, and you haven't, you've got a degree of experience, but maybe not as much, or the capacity to manage the investments, then a fund like this, you're really putting your money behind people who have taken companies from a small point and exited high. Two examples, Matura, so within the team are the people who built Matura, listed Matura, aggregated many other companies along the way, and then exited to Lifeline Japan for, I can't remember the number now, a couple $100 million Australian dollars, maybe a bit more. They also, the same team, built Diacrit from zero, right through to selling it to News Corp for a lot of money, buying it back from News Corp, and then reselling it again. So very strong exits. And one other example is the PropTech group, where it was literally from the ideation stage, is why don't we see if we can get this asset with this asset, put them together, create a really strong player in a market with a clear strategy, going along the way, acquiring some businesses, and then exiting 2.5 years later for just under 100 million Australian dollars. Which was a very good return for what was fundamentally a $20 million or so investment, so a 5 times return in a 3-year period. So from an investor perspective, great outcome. From an investee perspective, a target company perspective, scale is the game, right? If you're a company and you've got to get to scale, you've got to become relevant and you want to exit. 2 ways to get to scale: amazing execution from an organic growth perspective, and the second is partnering with others, merging to get to that scale. And that's where I think something like the fund can really help you do that, because of the relationships that we have. And we're working on a number of projects at the moment at Fusion for Ventures, where we basically have 2 or 3 companies that we know really well. We know they've got synergistic benefits, and we're trying to put them together to get to the point where we've got 50, 60, 70 million in revenues, and we now have something that we can then go to the next level and list on a stock exchange.
Yep.
And that's where I think the value is for both sides. So what I was going to suggest is that, and actually there's a couple of questions, which I actually should add. Could we put the questions up, please? Okay. What's your expectations as an investor? Exit in 3 to 5 years, IPO, exit in 8 to 10 years. How are you thinking about longevity in the fund?
No, so we were thinking long from a fund perspective, but from an investor perspective into the fund, is somewhere between 7 to 8 years horizon, you should think. We want to come in, as I said, in the seed stage where you have already revenues, you have clients, you're showing traction on the market, and we want to help you up to the next level. We have exited one company already when they came from in the Nordics already after 2 years, so it was 2 years a ride. But it can also be up to 6, 7, 8 years horizon.
Yep. And I'll add that for the fund that we're setting up in this region, given the stage, I don't think it's necessary for the investees, for the startups, to have a pre-described, clearly identify who the exits could be. but not a limited time. We will sell this business in 5 years. That's kind of the value that we bring as well, is creating that
and
value.
we also maybe not, it's not like the whole company maybe sold all the time.
Yeah.
We are taking it maybe to A-level, A round VC or B round VC, a bigger fund or P firm or less.
Okay. Can you put the questions up, please? I'll be up here. Thank you. All right. What is your opinion about debt, and what a value debt?
Okay.
Debt funding for businesses versus, and what's a reasonable interest rate to charge?
You want to go? I'll go. I mean, debt's always interesting. The reality is, why, if you're considering making a decision between debt and equity, why would you take debt over equity, where you assume that the equity is now cheap, and it will probably come back at a higher multiple? That's the bet. I mean, the reason why you would go, or you can't raise it. In order to get debt, it's very hard to get debt if you're not profitable. Very hard to get debt if you can't service it and you can't pay it back. Those businesses that are in that with those metrics are easier to raise money for. So I tend to skew more to capital, equity-based investments as opposed to debt. But the instruments serve purposes based on where you are. So it's not necessarily a bad thing. But if the decision was I can raise money, but I should take debt, I would take the capital.
Okay. When do you expect or predict, crystal ball time here, PropTech capital markets will shift up again, and will you ever see valuations return to the prior levels?
I think we're going to see shifts pretty soon, because it's actually what we need. As I said before, we need to see things happening in the ecosystem. We need big exits within PropTech, because the money is coming from top to down. If you look at all other tech sectors, you have big, Swedish companies, for example, who have been listed or sold, and then they are now pumping down money into the fintech, for example. And I think as soon as the whole system start to work again, more listings, etc., we're going to see a pretty fast take. And when the investors, which we have already realized, now is the time to invest.
Yeah.
When more of these family offices start to realize that actually now is the time. The success of Spotify, Skype, etc. Everybody came out of a crisis, and then you're peaking in 3 to 4. I think have we seen the peak of PropTech?
Yes.
We haven't even started. So in PropTech overall as well, for what we will invest is like smart cities, energy, etc. as well, and we have just scratched the surface on this area.
And I think in terms of seeing valuations return to some of these prior levels, I think people are far more wary now, and far. There's not that. If you think about it, there's a whole lot of stuff that came together, low interest rates, got to find a better return, and so on and so on. I don't think we're going to have all that perfect storm for ridiculous valuations emerge again.
But humans are not clever, Simon.
Yeah. I know. Yeah,
we all forget. We all forgot
yes.
COVID 4 years ago.
But don't forget,
we're coming back.
It's going to be AI-driven investing.
Yeah, true.
They don't forget. Okay. Last question: is raising money via IPO or private capital cheaper?
Cheaper? No, definitely not. No, I mean, the whole topic around IPO, I mean, we said the other day, an IPO is not an exit. I mean, it may be for your investors. It certainly isn't for those that remain in the company and remain running the company. But it's just the start of the next chapter. The good thing about being listed is easier access to capital, using the listed script as equity, using it as a currency rather. So buying other companies for shares, which is liquid, but it's certainly not cheaper, no.
Okay, well, last question, because this is a great segue into the Pitch Club. Let's say you have a startup, good business model, great markets, little competition, maybe, but you've just started and have no revenue. How do you value the company, and would it be advisable to get some traction before raising money?
Always a challenge, of course. I mean, I think Tiva York, I don't know if he's in the audience today, if we take away, AI and all this Web3 and everything, the valuation's just going somewhere, sometimes to the roof. I think you need to just get money for the table, actually, in the beginning, from your friends and families.
Friends, family, fools.
Yeah. Fools, friends, and family.
Fools, money, no.
Yeah. But I think the reality here is the more traction you demonstrate, the more confidence I have as an investor that I will actually get a return from my money. And that's super important. Gonzalo and I were last night, we were going to chat about a company that we've both invested in. last year, and they sort of promised, we're doing this, we're building, we're going to build all this and get some revenues. They did a good job of building the tech, but the revenues are about a quarter of what they said they were going to have. Clearly that makes us a bit nervous because they're now raising more money, trying to do it at double the valuation that we did last year, and it's like, wait a second, you haven't delivered what you said before. If you're going to raise more money, do it at maybe a discount, because remember, you valued yourself on what you were going to do and you didn't do it. Don't try to convince us you can actually do it more money. Okay, guys, thank you very much. We're going to move on to the Pitch Club now. Fantastic having your thoughts, and thank you for sharing them with us. Okay, we get this guy set up, the three over here.